For that brief introduction from the Vidodi Foundation. So let's start today's session. I'll set up few expectations as well as I'll give you an agenda of what we are going to discuss today. The prime, let's start with the agenda. The first, the point that we'll be discussing primordial today would be what do regulators expect from us valuers? We have been doing valuations, we have been issuing valuation reports. It has been going on for quite some time. Earlier, there were some cases that were taken up by IBBI predominantly with relation to appointment, predominantly with relation to admission of a valuer by the RBO, whether there was any pending case against him, whether he's a eligible person to become a valuer. All these things were discussed, and that's how major judgments were passed. That was the context under which major judgments were passed. But in the recent times, I can say somewhere from around December 22, January 23 onwards, there have been some cases which have been adjudicated by IBBI. And those cases predominantly pertain to how a valuer has done a valuation and the valuation report. These were the major things that have come into fore. I don't know what is the reason, but predominant cases that they have taken are all plant and machinery based valuers cases. I don't know why they've started with the plant and machinery probably, then they will slowly move on to land and building and SFA. We don't know how they are moving, but the cases, I think about for almost 3 years now, wherever CP sessions I take, I keep telling that IBBI is like a baby. Valuation, this profession is like a baby, and the regulators are still not yet, they are not ready. They are growing teeth. They don't have the strength to bite yet, but now they have some good amount of data as well as a lot of valuers. They've started looking at reports and now they have the power to bite. So slowly by slowly, they have started nibbling. That's the context. That's the agenda point. What are these cases? Where and all our regulators are trying to regulate our valuers, and what are all the areas where we'll have to fall in line so that we will make sure that we are towing the line that the regulators are drawing. So this is one thing that we are going to do. But there are a couple of cases, 6 to 7 cases that we will be discussing. I'll keep that in the, so I'm going to break this into 3 parts. Last half an hour, let's keep it for discussion. The half an hour before that, we will be looking at these cases. The first 1 hour, we first look at all the areas where valuation report, there is some guidance that is there from international valuation standards as well as IBBI. What are all the guidance that this IBS and international valuation standards as well as the IBBI is giving? We will try to figure that out. Once we figure that out, then reading that in context with the cases will make better sense. So that's what we are going to do today. Somewhere around 4:45-ish to about for about 10 minutes, I'll give you a break where I will be conversing with you regarding these questions, regarding the questions with relation to what we spoke about IBS and IBBI. And then probably after 4:30, we will have a 15 minutes to half an hour discussion about the cases or any questions that you have. So this is the agenda point. My expectation, if you have any questions, please raise your hands. You don't have to unmute yourself. I know that you have the option to unmute, but please raise your hands. In between also, if you have any doubts, if you want to ask it immediately, try to reserve it for the 10 minutes that I told you. But then if you have any doubt, if you want an immediate answer, please raise your hands. I will allow you to talk there. Okay, so that's the major point. Let me start with the PowerPoint presentation now. I'll try to make it as much interactive as possible. Wherever I ask a question, you can obviously unmute yourself and talk. Wherever you have a question, please raise your hands. So the context, when I say valuation guidance, I'm talking about valuation report related guidance, because that in itself will take this entire 2 hours time. It's going to take the entire 2 hours time. So I am going to stick myself to the major part of my discussion is going to go from the valuation report standpoint. From the report, wherever there is some scope for me to go outside that and talk about certain valuation related areas, we'll definitely discuss. What is a valuation report? This is not from a standard. From a general standpoint, what do you think is a good valuation report? It should be able to, a valuation report is a good valuation report if it is able to get the accurate and reasonable value for the particular asset. Not only that, but it also gives you the valuation report just on plain reading of it. It should give you the clear and concise explanation supporting your conclusion. I have this mobile phone. I tell you that, boss, I'm ready to sell this mobile phone. Why don't you find out what is the value, fair market value of this mobile phone? A good valuer is a person in his report. He will not only bring out the value of the mobile phone, but will also in detail explain how did he arrive at that value. I can say that this phone is worth 50,000 rupees, but I should explain what are all the inputs that I took, from where I have taken those inputs, why have I assigned that value. All these things I'll have to bring it out. An iPhone, I am not able to understand if you're anything that you'll have to converse with me. Probably you might have to switch out to English. Otherwise, I think this is a mistouch. So an iPhone 14, which is bought yesterday, can be valued at as low as 10,000 rupees. Why? Because that phone, it would have fallen down, or there is some bug in the system, in the phone, there is some problem. Therefore, the value can drop down. He could have bought it for 1.5 lakhs yesterday. Today morning, it can be valued at 10,000 rupees. Give reasons why. An iPhone which was bought 12 years before, it can be valued at 1 crore rupees also. Why? Because that would have been from the first lot of iPhones that were sold, or it could have been signed by Steve Jobs. Something or the other which is attached to it, you would arrive at a value. The point I'm trying to drive is the report that you're going to give should discuss why you have arrived at that value. Why you have arrived at 10,000, why you have arrived at 1 crore. You should be able to discuss, determine, and show. In this context, it is important that a detailed, transparent, and holistic valuation report is equally critical for valuation practitioners, clients, and regulating authority. Now, detailed, transparent, and holistic valuation report means you'll have to give everything in detail. 3 approaches of valuation. Under each approach, there are multiple methodologies. Leave alone methodologies. Which approach you choose for valuation needs to come out in the report itself. It should be at least that detailed. You should have considered all 3 approaches. In one of the previous sessions, I have told you, first what approach you should consider, market approach. Next to what approach, income approach. Third, cost approach. Why did you use first market approach? Why is next income approach? Third, cost approach? Because IBS says so. Explain it in the report itself. As per IBS, I have taken market approach first. Not applicable. Therefore, I went to income approach. And income approach, it is satisfied. Therefore, I did not see the use of cost approach. You can write it in the report. Right? Put it all in the report. If you are using 2 approaches and you are trying to do an average, weighted average, or a simple average, whatever average you are doing, how did you choose 50-50%, or how did you choose 70% for 70% weight for one approach, 30% weight for another approach? Write it in the valuation report. That's the level of detailing that is required. Transparent. Anything, everything that you have taken, information that you have taken, how did you calculate? What is the methodology? Any calculation that is being made, maximum possible extent disclosed in the valuation report. Where did you take your risk-free rate from? You would have taken it from RBI website. Write it here. If you have taken it from investing.com, write it here. When you, as long as you can very transparently say, this is where I have taken my data from, and this is how I have calculated, you will be in the safe. Holistic valuation report means all this put together should come as a single context. The conclusion alone and the client explanation alone is not important. Everything else should come. Now, it is important for clients, valuation practitioners, and regulating authorities, because clients and valuation practitioners, you are able to ascertain, understand why both of us are required to have a very detailed, holistic, and transparent valuation report. But the regulating authority is also looking at it. They would want to take certain decisions based on it. And when they take that decision, they would want all this information readily in front of them for them to take that correct decision. Because of the key role of the valuation report is communicating the conclusion of evaluation to the readers IBS has put forth the two predominant principles of objectives of valuation report. The first one would be reporting requirements. The next one is elements. Reporting requirements is you'll have to discuss in detail about the requirements consistent with the professional best practice. What type of value are you supposed to ascertain? You cannot say the value of the asset. Are you discussing about fair value? Are you talking about liquidation value, fair market value? Is it a liquidation value under stress? Liquidation value can be ascertained as a going concern also. If you go back to IBC, you can actually find out that liquidation value can be calculated even for non-forced transaction where the concern is a going concern, but you want to find out the liquidated value. So you'll have to be very careful. All those things needs to come out. That's the reporting requirements. And elements is the identify the essential elements to be included in the valuation report, which is anything about the asset, about the valuer, about the clientele. All this needs to come out. So reporting requirement and elements, these two are principal objectives of a valuation report. Now, let's move on with IBS3. What is its application? It is applicable to all types of valuation reports. Any valuation report where you're going to say that I have complied with international valuation standards, IBS3 has to be followed. Instructions, some instructions involving valuation undertaken for specific purpose may differ from those given in the other assignments. Refer to those respective standards. Just like for chartered accountants or people from SFA might understand, there are accounting standards where income recognition can be given in one standard. But when you go to a specific standard like construction contracts or some specific kind of contracts, that particular specific standard would overrule. The same way here, the valuation reporting is predominantly governed by IBS3, but in case of specific valuation requirement, if there is a special standard that follows it, you'll have to go there and you'll have to comply with that standard. Compliance incumbent upon both internal and external valuers. If a company has its own internal valuer also, if he is following international valuation standards, he has to follow this IBS3. Now, what does IBS3 talk about? They define valuation report. A document that records the instructions for the assignment, which we very fondly call the purpose of valuation. What is the purpose of valuation? That will be your instructions of the assignment, the basis and purpose of the valuation. Okay, they have explained it, and the results of the analysis that led to the opinion of the value. So you did your analysis. What analysis you did, that has to come out. Who has asked you to do the valuation? What are the instructions? So that instructions will include the basis and the purpose. And then finally, what is your conclusion? That needs to come out as a document. That's going to be your valuation. It may explain the analytical processes. They are saying may, but it is one of the mandatory requirement. You'll have to explain the analytical process undertaken in carrying out the valuation, the present meaningful information used in the analysis. Valuation report can be oral and written. Predominantly, it's not oral. It's predominantly written, because in India, at least, we have written reports that are mandatory. Oral reports can be there for other countries. It's a broad umbrella. IBS3 is a very broad umbrella, but let's take what is required for us. It will be written predominantly. The type, content, and length of the report vary according to the intended users, legal requirements, and the property type, nature, and complexity of the assignment. Each and every valuation report might differ. It can be the same asset, but still, if it is for a different act, it will come in a different format. If you are using Income Tax Act, entire international valuation standard itself will not apply. You'll have to go with a given methodology. They have a methodology under 56 and the rules that is there. You'll have to go under that and you'll have to do the evaluation, where all three approaches of valuation does not come into play. FEMA you take, it's a different, you go on with fair market value. There is a different definition here. With the IBC, with regard to Companies Act, you go on and calculate the fair value or the liquidation value. Fair value and fair market value are different. So though essentially the context is the same, but then the terminology are different, the definitions are different. So for each type of valuation, within the purpose, within the meaning and the environment and the asset, the valuation reports type, content, and the length, it will vary. These are all textual content. Bear with me for quite some time. I think whatever we have done, that is the bearing part. Now going forward, it will be a little more engaging. I'll try to make it a little more engaging. Now, they have the International Valuation Standards Board. They have come out with a minimum requirement which you need to follow. You have to follow. These are all parts of the report that should come in any valuation report. Number one, conclusion. This, irrespective of whatever happens, that is the entire reason you are going to do this. You are doing a valuation. So, what is the value? What is the final conclusion of value that needs to come out? Identify the client, relevant dates, and intended use. I will go by one. Slowly, we'll go. Wherever you have any doubt, you can stop me then and there. The conclusion should be clear and accurate and set forth in a manner that is not misleading. This is what the international valuation standard says. It means that you have to be very clear and accurate. What is clear and accurate, sir? 250 rupees, not 250 rupees per share value. Or this particular asset is worth 2.5 crores, not 2.5 crores. We'll have to be very careful when you are giving all these conclusions. You'll have to have, we all do it, as a muscle memory, we all do it correctly. But you'll have to be very careful when we'll have to consciously also do it. Number one, what currency that you're valuing it? Are you valuing it in INR? Are you valuing it in USD? Probably all your computations could have been in USD. But if you have not mentioned anything at the bottom in the conclusion part, that might be a misleading statement. It can turn into a misleading statement. In Indian context, everything is in USD, but you have not mentioned anything yet. People might misunderstand it as INR. So any value conclusion should have a currency. That is number one, primordial. Number two, the value that you have arrived is for the entire value, or is it a per share value? In the context of SFA valuers, the enterprise value or entity valuation or equity value, whatever value that you have arrived, whether are you, if you are giving the entire value here, mention that it is the equity value of the company is so many crores. If it is boiled down to shares, then mention that rupees 250 per share. If you are calculating on a fully diluted basis, mention that rupees 250 per share on a fully diluted basis. You'll have to mention what is the value 250. It is an INR currency rupees. It is per share value on a fully diluted basis. Now, before that also, before the rupees starts, you would have mentioned the fair value of the asset. Mention fair value. Don't write value. Don't write the value of the asset. Write it as the fair value of the asset is so much. The liquidation value of the asset is so much. Fair market value of the asset is so much. If there are some condition precedent to it, where you are calculating the liquidation value on a stressed basis, where you are there is a lot of stress, the company is under is not a going concern, you have creditors standing outside, you want to go and value this asset, and you'll have to settle all the obligations within a limited time frame, then mention all those things in the value conclusion, so that the value that you are arriving will include the basis and the premise. This is important. Conclusion. Next, conclusion. I think it's 2-3 lines, but I think the maximum possible clarity I have given. Any doubts, stop me here. Identify the client. It's important to have a better understanding of what is important to the clients, what do they need. So here, identify the clients. You'll have to talk about the client. Who is the client? For whom are you valuing? You can be valuing. So recently I did a valuation for a company in India, which is a holding company of a subsidiary in the United Arab Emirates. I don't know, some Middle Eastern company. I forgot a country. I forgot the name. So I'm going to take UAE. I think it's the UAE. So they have a subsidiary there in the UAE where our company, Indian company, is going to be the holding company. They have invested money. They are trying to liquidate that company and they are bringing the money back into India. When I am appointed the valuer, you'll have to be very careful. The company that has taken my services is the Indian company. Now I'll have to give the entire detail. A lot of times what happens is people get confused. They go on and give the details about the company which is already liquidated. That is liquidated in 31st March. How will they first appoint you? So I'll have to be very careful to first introduce the company which is appointing me. I'll have the appointment letter, etc. First introduce the company that has appointed me. Then talk about the context in which I am being appointed. I am being appointed for the purpose of FEMA because it's an inbound transaction. Money has come into India by liquidating the company outside India. They have liquidated and they have brought it into India. I explain about Indian company. I explain about the reasons, circumstances under which I am appointed. Then I talk about the foreign company. Then what is the investment of this company in that company? Then I go on with the valuation. This is absolutely necessary. Start always with the company which has appointed you. And then in case that company wants you to value their investments in another company, from there you explain the other company, their business, bring on the details. You should probably give the details of the shareholding. In the UAE, there was a peculiar concept where this company was holding 50% only, I think 49%, 49.5%. More than 50% should be held by a resident in the other country. So what happened is this: these guys, they held 49.5%, and apart from that, through one of their directors, they were holding the remaining part with an agreement with the director that share also will finally vest with this company. Therefore, they sold the entire company. Entire money came into this company, the Indian company. All these are detailed items that needs to be identified, and it needs to be disclosed in the identity of the client. Because if you don't explain it here, people will not understand. What will they understand? They will not understand why 100% money came into India while only 50% is held by the company. Relevant dates, international valuation standard is very clear. They are not bothered about where was I? So they are interested about the valuation date. They are not bothered about the appointment date at all. IBBI in their guidance, they talk about appointment date. Here they are not bothered about appointment date. Give the valuation date. I am appointed on 1st of January to do a valuation on 31st of December. I go and do an inspection on 10th of January and I submit my report on 15th of January. They are asking about the valuation date, which is inherently 31st of December. Till that date, what is the value is what I'm trying to find out. Appointment date of 1st of January, they are least bothered, but IBC, there is a requirement, you bring it here. Date of report will be 15th of January. Date of inspection, the date on which I went and did the inspection physically needs to come out. This is not as a requirement as per IBC, but if you are if you are writing your report, I've been telling use 4 dates. IBS is asking you to bring the 3rd date. Appointment date is not talked about in the in the international valuation standards. IBC asks for it, but IBC is not asking for the inspection date, but IBS is asking for the inspection date. So 4 dates: valuation date, appointment date, date of inspection, date of report. Finally, intended use of the valuation. What is the purpose of valuation? You'll have to bring out. Who is going to be the intended user? There have been cases where my valuation report as a registered valuer has been taken for the purpose of Companies Act by the company for their compliances with regard to Companies Act, which I already explained. Now, this same report without my consent has been taken by the investor for the purpose of FEMA. And then one fine day they came back and they told me, sir, they are asking us to make a small change. I asked them, what is the change? Oh, they want in the purpose, they want to add foreign exchange management act. I said, what is the requirement? I've been appointed for the purpose of Companies Act. How can I give under the FEMA? FEMA says it needs to be signed by a chartered accountant or merchant banker, but then anyway, it did not come under the scope under which you have appointed me. That is fair market value. This is fair value. How can you ask me this valuation report? Then they are saying that investors are interested in taking this report. I tried to convince them this is fair value, that is fair market value. You cannot take this valuation report to RBI. They might not accept it, but then they kept insisting me. Therefore, I, through a written consent, written application, asked them to write a report asking me permission to take this report and share it with RBI. I gave them the consent with a disclaimer that this report is not prepared for the purpose of FEMA. It can be shared, but the value that I have arrived is only the fair value, not the fair market value as per the guidelines of FEMA. Still, they took it, they submitted, somehow they were able to run the show. So, intended use and users of the report, if you are not mentioning, they will take your valuation report, go around and circulate it for all purposes. They will submit even to the investor stating that so and so professional has certified that the company is worth so much, you invest in my company. And the investor, they will, if they are, usually they don't do, even if they are shrewd enough, they will do it. They'll keep a copy of this valuation report if you have not taken sufficient protection. They will take the valuation report. They'll invest. Tomorrow there is a loss. They'll come back. They'll show this valuation report to us valuers and say that you have given a valuation report based on your professional judgment only, which is given to me. I have taken this financial transaction. Now I have been aggrieved. You'll have to compensate for the loss. So all this is possible. You have to stop that by protecting yourself in the valuation report. Now, moving forward, the other few items: basis of value, premises of value needs to come out, property description, scopes and extent, and unusual assumptions. Now, what is basis and premise of value? That you should describe the fundamental premises on which the reported values will be based and to be appropriate to the terms and purpose of the valuation report. Now, when you are doing a valuation for the purpose of, let us say, you've been appointed as an valuer for the purpose of insolvency case. Under the Insolvency Act itself, you are supposed to prepare two values, fair value and liquidation value. Mention that you have been appointed by the resolution professional for the purpose of valuation under Insolvency Bankruptcy Code. Therefore, I am doing valuation under two bases, which would be liquidation value and fair value. That needs to come out. Next thing, premises, whether it's a forced liquidation, whether there are 8 different types of possible asset sale that is possible. You'll have to be very careful whether it is being sold on a piecemeal basis, it's sold on a group of assets is being sold, or a particular business vertical is sold on a going concern basis. That needs to come out as the premise of valuation. Next, identify and describe the property to be valued. Most of the time what we see is very basic detail about the property comes out in the valuation report. You'll have to be very clear. You'll have to give maximum possible information. If it is plant and machinery, now when the particular assets are purchased, if you are not able to give it in the face of the report, at least put it as an annexure. Basic report details like when the asset was purchased, when was it latest it was valued or revalued, when was it serviced, what year make it is, what is the capacity of that particular asset, who is the maker, what is the manufacturing unit's name, from where it is made. All these things needs to come out. Rights or interest in the asset needs to come out, whether it is mortgaged or not, hypothecated or not. All this needs to come out. Physical and legal characteristics, what condition it is at the time of you visiting it. There can be assets which will be completely in a condemned condition, certain assets which might be in a running condition. Whatever your observations, describe, and in the part of identify and describe, you'll have to mention those items. If it is a large list, give it as an annexure, but it should form part of your valuation report. Classes of property, what class it is, all those things needs to come out. You see, it is very simple. There is obviously any company which you are going to value, they will have to maintain a fixed asset register. You're going to take the fixed asset register. In the fixed asset register itself, more than half the information that I'm talking about, it's going to be there. You're going to reproduce it into an Excel sheet. Any further observations you're going to make, you're going to put it there and you're going to give it. It should be as simple as that. Scope and the extent of work used to develop the valuation, predominantly it will come in the engagement letter. Summarize it, give it in the valuation report also. Special, unusual, or extraordinary assumptions and address the probability that such condition will occur. This is again very, very important. Usually, the case that I explained, the iPhone, the first generation iPhone that was there, somebody is valuing it at 1 crore. It can come to me. I'm valuing it at 1 crore. There's an extraordinary assumption that was underlying. What? It has been signed by Steve Jobs. The first lot. There is a separate set of people who are ready to pay any amount of money to buy this kind of an asset. All these are extraordinary assumptions. Separately mention it here. Normal assumptions needs to be separately mentioned. These are all special, unusual, or extraordinary assumptions in bold or in a separate place. You are going to mention all these items so that people will be very clear as to why a mobile phone is being valued at 1 crore. Next 4 items: significant assumptions. What is unusual assumptions, significant assumptions? There's a small difference. Confidentiality, market analysis, valuation approaches. Significant assumptions are all the assumptions that are not unusual but significant. So a mobile phone can be valued. These are all extraordinary. Steve Jobs signing it, or it's the first generation, first batch. That's a different story. But if it is a normal mobile phone, you are trying to value it. You have arrived at this mobile phone can be used for the next 4 years. That's a significant assumption with regard to that mobile phone. It will require service for the next 2 years. It might not require service for the next 2 years. Then 2 years it will require service. These are all significant assumptions that needs to come out. Statement informing report is confidential to the valuer and the intended users that no liability can be accepted by the valuer for the third party reliance upon the report. IBS is very clear. They are saying that you come out with this. They have entirely drafted the entire sentence that you'll have to come out with. They are saying that this valuation report is confidential, should be used only by the user and the valuer. If a third party is using it, take permission from us. Obviously, regulators are excluded from this. They can any day use it. But other people, anybody who's investing or other people who are not intended users of the report, they are using it, then we will not accept responsibility. The valuation standard itself is trying to protect the valuer here. All that we'll have to do is copy paste in our valuation report this particular sentence to make sure that you are not dragged into unwanted, unreasonable consequences. Market analysis performed. All our valuation approaches use the market information, market data. This market analysis that you perform to arrive at the market data needs to be given in the report. There's a specific section where anything, it can be the beta, it can be risk-free rate, it can be the market premium that you're talking about, it can be comparable company, it can be comparable asset. All that needs to come in the manual market analysis performed. Valuation approaches and procedures followed. Again, very important, as I previously told you, all three approaches should always be considered. After considering all three approaches, give a reason why one approach is considered, why another approach is not considered. If you are using two approaches, please ensure that you are saying that you have used two approaches, considered two approaches, arrived at a value, this value, you have given this weightage for this approach, this weightage for this approach. Why that weightage for that approach should also be mentioned. Take this from me. Any number, numerical, that you are mentioning in a valuation report, if it has not come from the management, even if it has come from the management, you'll have to check for reasonableness. But if it is something that you have arrived, you have taken it from the you have taken it from the market, or you've taken it from the internet, or you have arrived, you have made some assumptions, give proper detailed illustration as to how you have arrived at it. If you are saying there will be a 5% obsolescence, make sure that how did you arrive at that 5%. If you are saying that this will be depreciating at the rate of 20%, please come up with a solution. How did you arrive at 20%? It can be very simple as borrowing the same assumption as Companies Act. You can very well say that Companies Act, regularly it is taken as 20%, therefore I've taken it 20%, 60%, whatever it is. But please make sure that it comes in the report. This is how I have liquidated and I arrived at this percentage or this amount. Otherwise, time and again, we are seeing that when the valuation reports to scrutiny by IBBA, they are asking, how did you arrive at this number? And when the valuer does not talk about how they are able to do it, they are saying that you have not, this is very abstract. You have come up with some random numbers from your mind, which is not reasonable. You cannot say through experience, I think it should be the value. You cannot say that. Some liquidated calculation should be there so that you are safe when it goes to IBBA. Reasonings, prohibition clause, compliance statement, valuers details. Other things are fine. Compliance statement, I'll come after I finish the other three things. I'll come to compliance statement because it's a little detailed. Reasoning supports the analysis, opinions, and conclusions. Any conclusions that you have drawn would be based on the analysis. It will be based on our opinions. The reasoning for those analysis and the opinions needs to come out. The prohibiting compliance statement, I said I'll speak later. Prohibiting the publication of a report in whole or in part, or any reference thereto to the valuation figures contained therein, or to the name of the professional's affiliation of the valuers without the prior approval of the valuer. Again, this is something that we already spoke about. There should be a specific clear clause stating that you cannot use the report without my permission. If you use it, anybody who uses it, I am not liable. But to the user, you'll have to say that don't share it or publish it without my approval. Complaint statement, I'll come a little later. Final one, this is pretty straightforward. Name, professional qualification, signature of the valuer needs to come out. Insolvency bankruptcy code says that you'll have to also mention a line that I am not related to this company. I don't have any prior business transactions with this company. I'm an independent person. Even my relatives, I'm not even indirectly, my relatives are connected to this company. All this needs to come out. So what is the number of years if you have been related to this company? The past how many years if you are related to the company, you'll be you're not allowed to take up the assignment. Anybody? Quick recollection of facts. How many years before if you are related to the company? So you've been appointed to not for valuation. So you are the statutory auditor of the company. For the next how many years you will not be able to take up a valuation assignment? Anybody? I'm just trying to wake you all up. I know it's 4 o'clock, but still a little bit hangover will be there. Anybody who wants to answer it? I've been related to the company for the past so many years, or in the past for so many within this years, I'll not be able to take up the assignment. No. Why, sir? Why, sir? I was expecting at least 1 or 2 answers. 5 maybe? No. Come on. 5 is an answer, but the question, I will change the question a little later so that 5 becomes the answer. But what is the answer for the question that I asked? You cannot take up the assignment if you have been related to the company in the past how many years? Sir, we're all valuers. Three years. Beautiful. Thank you. No, not lifetime, sir. Lifetime and all. Then if you have been just because I have done some transaction with one company for once in my lifetime, I will never be able to do the valuation of the company ever. It's not like that. 3 years before, if you have within 3 years, you cannot take up the assignment. And if you have become a valuer, next 3 years also, you should not take up any other assignments. If you have done an assignment, except for valuation, any other assignment, 3 years you will not be allowed to take up a valuation assignment. And once you take up a valuation assignment, next 3 years, you cannot take up any other assignment. Internal audits, if you cannot be participating in any tenders of the company, all these things will come into play. 5 years, the question is, if you have been not related to the company, but there is some transaction between 3 years to 5 years. If it is within 3 years, now you will not take up. But 3 to 5 years, you should report in the valuation report. The IBC very clearly states that in the past 5 years, if you are related, mention in the valuation report. If you are related and you are mentioning, there is a related transaction and you are mentioning, then it should be between 3 to 5 years. So that's what I am trying to say here. So that needs to come out. Name, professional qualifications, and signature of the valuer. Also, IBC says bring out all the experts or other valuation registered valuers that you have consulted or taken in their services. You'll have to mention it here. I might be a registered valuer for SFA. I'm valuing the company's shares, but they have plants and machinery, they have land and building. For the entire value to be assigned in an NAV basis, NAV approach basis, cost approach basis, I'll have to go and approach a land and building and plant and machinery valuer. I'll have to take their names and their professional qualifications also, mention it there, mention it as a separate line item, the experts involved, mention so that I'll be putting my weight on those valuation reports. If something goes wrong with that report, only that particular person will be taking onus, or they will take responsibility for it. Now, I told you that we'll talk about complaint statement. There's a specific complaint statement that you'll have to follow. What are all the points of complaint statement? Statement of facts, analysis and conclusions, valuer's interest, valuer's fee, inspections, valuers' experience, valuers' educational qualifications or requirements, ethical code and valuation standards performed. All this needs to be coming out in a separate statement called the compliance statement, which we blend it along in the valuation report. It's fine, but at least these are all also part of your valuation report. That's why I included this. Statements of fact presented in the report, correct. It should be, there should be a statement which states that the facts that are mentioned in the report correct to the valuer's best knowledge. If you are looking at the entire valuation will be based on the projections of the company, you should do a reasonableness check and make sure that at least it is okay to bring it in the report. Somebody cannot say that I've been making 1 crore rupees for the past 10 years. Tomorrow, next year onwards, I will be making 2,500 crores. Not possible. Reasonableness check should have gone. Analysis and conclusions limited only by reporting assumptions and conditions. What are all the analysis and conclusions that you have drawn? It is only limited to the assumptions that I mentioned, reported in the valuation report. Nothing else will override it. That needs to come out. Valuer's interest, whether am I an independent person or not. Compliance report you will have to say, which essentially forms part of your valuation report. Valuer's fee. At any point in time, obviously, our valuation fee will not be a part or a percentage of the, it's not contingent upon the any aspect of the valuation report. So essentially, it's not a percentage of the valuation that we are arrived at. That is something that you'll have to bring out very clearly. Inspections. Valuer has or has not made personal inspection of the property, needs to come out. IBC, October 2020, they came out with the guidance where they are talking about desktop valuation. When there is a desktop valuation that is being done, you'll have to very clearly state that I have done a desktop valuation. I have not gone and physically done the valuation. You'll have to be very careful also for the fact that desktop valuation cannot be done in the case of liquidation valuation. When you are while trying to arrive at liquidation value, you cannot do desktop valuation. You'll have to go and physically verify. So how did you do the inspection needs to come out. But in the interest or being overexcited, in the case if you have not gone and verified for a liquidation value, you should not mention that I have not verified even for liquidation valuation. Liquidation valuation, you have to go physically verify and mention it here. I have went and I have done the valuation. Values experience in the location and the category of being of the property being valued. Here is where we talk about being a registered valuer, the experience that we have that needs to come out. Valuer's qualification. How are you qualified to do the valuation? In the case of FEMA, a merchant banker or a chartered accountant are qualified people to do valuation. That they will say, I am a chartered accountant, I am a merchant banker. In all other cases, registered valuers are there. You'll have to mention that we are a registered valuer under what asset class, and therefore we are eligible enough to do this valuation. Valuation standards. It should be as per the valuation standards. Any person who is doing any valuation, whatever RVO you are registered under, they will have a valuation standard to be followed. Predominantly, all the RVOs are following international valuation standards, so we'll follow the international valuation standards in DJF RVO. Probably only ICA is following the ICA valuation standards, which is pretty much similar to the international valuation standards again. Now I think before going to IBBI guidelines, which is issued in the October 2020 guidance, we'll quickly open the session for the next 10 minutes to have a quick discussion of any questions that you have. We'll discuss about that, and then we'll move on to the next leg of IBBI guideline October 2020. What are all the important points? I'll share it with you. It's pretty much something that time and time again I have in my multiple CPEs I've talked about. Other valuers have also talked about in multiple forums. So before we go there, please go ahead, ask your questions with regard to so far whatever we've spoken about or anything in that regard or relation. Please feel free to open up and ask. I'll be able to answer. Then we'll move on to the next part. Is everyone using all these contexts that all these headings that we are talking about? Are we all using all these headings in our valuation report? Are we giving all these informations in the valuation report? If you have not been giving, at least please take note of it now. I'll definitely share this Excel sheet, I mean the PowerPoint presentation. Please make sure that you are taking parts of it, do your own analysis, research, and then add it. If you want to be a little bit more detailed also, that's fine. Okay, I take it that there are not much questions at this point in time. Yeah, go ahead, sir.
Sir, I have one doubt.
Yeah.
Santosh sir.
Yeah, please go ahead.
Sir, when you had mentioned that we need to give a holistic valuation report. So, see, at times historical data, so that also be mentioned in the report because that is already present with them, right?
You're talking about book value.
But sorry?
You're talking about book value?
Yeah, suppose we're doing a NAV, net asset value method for a company, like presently I'm doing a merger. So they're going to take over. And that company, so can I just present the net asset value as in with its schedules, or should I give them the historical data also in the report?
If possible, I understand the question that whether, see, sir, the information about the asset is already with the client. Why should I replicate it in the valuation report? The question is not whether the information is available with the client or not. The question is whether the information is available with the valuer or not. Whether the valuer has taken all this information and whether has he considered in his valuation all these factors before he comes out with the fair value or the liquidation value.
Yeah, so for that, should I replicate the
100%
historical information or just give it in our schedule as current assets, current liabilities?
No,
is that enough, the total?
I would suggest not to go with the schedule. You don't club everything together and give it as current assets and current liabilities. Individually, each asset needs to be discussed, and how you arrived at the value for each asset needs to come out separately.
Place that as notes, will that be okay? Like I put a number and explain it as notes.
You can take it as an annexure outside also, separately calculate, and you can say that for this particular purposes, you can go and refer to annexure number 2, annexure number 3. That is absolutely fine. Because there are big companies where the fixed asset register itself will run into thousands of line items. And if you add it in the main valuation report itself, it might not look nice. Because we will start somewhere and then all this will come for several pages and then you start with the next chapter. So it is okay to take it to a different annexure, but it is very, very important to bring it in the valuation.
Okay.
Any other questions?
Okay.
Yeah. Any other questions?
So I don't have any question, but I want to highlight one thing here. Generally, at least I'm working for most of the banks. Like I'm working with banks. I don't like working with the companies or under with income tax.
Okay.
So banks, as you know, that they have their own formats, and most of the things are not covered in their formats that you are like suggesting for. So what to do in that case?
I understand, but in the formats given by the banks can be enhanced. Whatever detail that is asked by the banks, you're going to retain it. You're going to give additional information. All these are going to be additional information that you're going to give. As long as you are doing the valuation under the name of registered valuer, you're doing it through your RVO. Since you are doing it through your RVO and the RVO mandates that you'll have to do the valuation as per international valuation standards, you'll have to follow these guidelines. If you are a chartered engineer, as a chartered engineer, you are doing a valuation, that's a different story. If you are a chartered accountant and as a chartered accountant, you are doing a valuation, that's a different story. But if you are a registered valuer and as a registered valuer for an asset class, if you are doing a valuation, be it the bank, be it for another regulator, it doesn't matter. They will definitely have a format. They will give you a format and one-pager format, which they will say, sir, total assets, you put it this side, total liabilities this side. This is how you do the valuation. That is fine. Probably the format that they have given can be kept as an annexure also, because for their reporting purposes, for their system purposes, they will ask you to give it in a separate format. That you can give it as an annexure, but this entire report needs to be prepared. That being said, you might definitely have a question, sir, the fee that they are giving, would it be commensurate to prepare this entire detailed report? That would be a right question that you would ask. But I would say, once we start signing off as a registered valuer, we come within the ambit of not only the bank and other regulators, but we also come within the ambit of IBBA. There is a disciplinary committee that is being formed. For all valuation reports, in most of the RVOs, they are asking us to submit all the valuations that you have submitted. There are certain RVOs which are asking for VRN, valuation reference numbers, just like UDIN, UDIN or document identification number. They are creating some numbers. Only if you have that number, that valuation report will be valid. Since we are creating that, the RVO would know all the valuation reports that we have created. On one fine day, they would ask for all the reports for their peer review purposes. They'll go through our report. If they find out that these items are not there, then it essentially amounts to contravention, which can be referred to IBBA. Then unnecessarily we will be called up for question. Then we'll have to, at that point in time, we will not be able to explain them that the fee is not demonstrated. Therefore, we should make sure that we should make our bankers and other users understand that we have a set guidelines that we'll have to follow, and the fee needs to be increased. There we should go, but not, we should not reduce our standards here.
Okay, sir. Even though the fee decided by the bank, even we are not getting that fee itself.
I agree. I agree. That's a big problem, not only with valuation, but with concurrent audit. Anything with relation to bank, it's a big problem. But then at least these are important areas that needs to be handled. You will definitely, most of the items here are going to be format driven. Most of the items, once you put in the effort and create it for one valuation report, it will be repeated. As you'll have to just read through it once, and any change you'll have to make some corrections, but otherwise it will be a standard format.
Thank you, sir. Thank you so much for your advice.
Sure. Any other questions?
Sir, I have one small doubt also. When you mentioned basis of value, we'll have to mention in our report the basis of value, right? Like which value we are considering. So, sir, I have a small doubt with equitable value and fair value. See, if, as I said, I'm doing a merger, if it is for identifiable persons, don't we take it as equitable value?
No,
So is that the value of the mention?
Equity value. You're talking about equity value and fair value. Fair value and equity value will sometimes go hand in hand. Equity value, operating assets value, these are all a different set of values. So what is the equity value? What is the enterprise value? So I think in one of the classes also I've explained, if you arrive at a value on an enterprise basis, then it is enterprise value. Then from there, if you remove all the non-operating assets, or sorry, if you add all the operating assets of the company, then you arrive at the value of the company. Then if you reduce the debt holders fund from it, then you arrive at the equity value. This is a separate story. This is a billing. The calculation wise, this is value. Fair value, the fair market value, liquidation value, arm's length basis value, all these are different. These are all the basis of value. This is calculation based. We are saying enterprise value, equity value. These are different. Fair value, etc., is the basis of value. Okay. Any other questions from anybody? We have a few more minutes, couple of minutes more. I have a chat question. Oh, that's not a question. Right.
Sir, and in dates also, is our appointment date valid when we are appointed to do the valuation? Is that a valid date?
Is it a valid date?
Is it a relevant date in the report?
It's a relevant date. That's what I told you. In international valuation standards, they are not bothered about the valuation appointment date, valuer's appointment date. But in one of the guidances of IBBA, they are asking us to give that date. Therefore, all 4 dates become automatically mandatory.
Okay. Sorry.
Yeah. That is also again that brings to the question. Time and again, I've been repeating this. CEP also I'll repeat. Who will appoint a valuer?
Board of Directors, Audit Committee.
Audit committee. Only the audit committee has the power to appoint a valuer in the absence. When I say absence, non-constitution of the audit committee, board of directors can appoint this. If there is a company which has board of directors, under which an audit committee is formed, but the audit committee did not meet. 5 people are there in the board, 2 people are there in the audit committee. I'm just making some assumptions here. Those 2 people did not come, they are out of station. The other 3 people, if they start a board meeting and they appoint you, it is not valid. In the case of non-constitution of the audit committee, then only board of directors can appoint us. In the case of IBC, resolution professional will appoint us because the powers of the board are suspended, and then it is vested upon the register, the resolution professional to do as it may deem fit for whatever the board of directors have to discharge. That responsibility will be cast on the resolution professional. Therefore, he can appoint you as a registered valuer. Right. So with that context, if there are no questions, let's move on to the next question. Next part of our discussion, IBBI guidance 2020. So the October 2020, in October 2020, during the peak of COVID, there were a lot of questions that came out to IBBI for them to address. One predominant question was, we are not able to move, sir. How do we go and do the valuation? So many valuation cases are coming to me. I am not able to go anywhere because of the restrictions. How do I do valuation? Next question, valuation report. So much confusion is there. So many people, they have gone through the valuation reports that were submitted in 2017, 2018 and all. There were a lot of cases where valuation reports were in one page. One single page, they have given a valuation report where they will give the conclusion value, a broad detail about the company, broad detail about the asset. That's all. Nothing else will be there. So there is no guidance from the IBBI. Then how can you expect them to fall in line and give a proper valuation report? This was a big question mark for a very long time. Therefore, IBBI came out with this beautiful guideline where they talked about predominantly disclaimers, caveats and limitations, but they also touched upon the facts of the valuation report. You'll have to give these 4 items. There are about 12, I think 12 to 13 items are there, 12 to 16 items are there. But then the first one is the background information, basis of value, premises, purpose of value, identify the RV. Again, these are all the repetition of what we have seen earlier. So I'm going to skip wherever possible. Background information, you might have to talk about the asset. If it is about the company, talk about the company. What is the company engaged into, whether it's in the technology sector or not. All these things needs to come out. It should make sure that unfamiliar people who are using this valuation report also come in par with the familiar people. You cannot give extremely detailed discussion cannot be done, but reasonable detailed discussion needs to go through there. Purpose of valuation, identify the registered valuer as well as the other team members or external experts. This is where I'm talking about. If you have used another person, you'll have to bring that person here. I talked about other registered valuer. I'll again talk about another story which I keep telling about. One case where I have done the intangible asset valuation of another company. For that company, it was into the field of oil extraction related material or mineral manufacturing. They create something called starch, which makes sure that when the drilling happens for oil, the drill bit does not get hot and it will not melt. Because at the speed at which it is drilling, the drill bit itself will melt. To stop that from happening, they'll have to pour water. But before the water even reaches the end of the hole, it will evaporate because that much heat will be generated at the drilling place. Therefore, they'll use something called starch. They put that starch inside so that the drill bit will not get hot. For the manufacturing of the starch, they have a process which got patented and they wanted a valuation. In this case, I had to engage a legal expert who will talk to me, who will give me an idea about the patent laws of the US, patent laws of India. Then I needed one more person who is an hydrocarbon or an expert of drilling for oil, who will be able to go around at the market, tell me that whether this kind of patent has already been licensed, who's using it, what is the technology, whether it is in par with the technology these guys are using or not. All these things I took testimonials from these people, the legal expert and the mechanical engineering expert. I took their name, gave it to the part where it's talking about experts. Now these testimonials have also come part of valuation report. Tomorrow, If somebody is going to ask, sir, 50, you have said 15 years. How did you read the US law? I will very clearly say, I did not read, but I have engaged a legal expert who did the analysis for me and who gave it to me. Obviously, I did some basic research. That's a different story. But at least I will be protected because I am not a lawyer. I am not good at reading the law. I have engaged somebody to read the law. Okay, I'll directly go here. Intended users, date, disclosure, inspection. Intended users already discussed. Date, as I told you here, date of appointment needs to be separately given. The report should also mention the timeline associated with the validity of the report. This is again one important point. Wherever possible, tell that how long this valuation report is valid for. There are a lot of confusions. RBI has previously allowed valuation reports for 6 months with 6 months validity. Now they are saying it's valid only for 3 months. In one of the note, they are mentioning it's only valid for 3 months. If you are giving a valuation report, restrict it to a given period, 30, 60 days, 90 days or 180 days. You should restrict it. Otherwise, the fundamental assumptions would change. How many of you know about a startup called Byju's? Please raise your hand. How many of you know about Byju's? Okay, one. I hope a couple of people would know, at least 70-80% of you would know what Byju's is. They are a edutech company. 6 months before, if you have gone and read articles about Byju's, aha, oho, this company is the best company. These types of companies would take India's name to the forefront across the globe. All this were the news. Now today, if you go and read about Byju's, the story has unfolded in a different pattern. From the board, 4 or 5 people have resigned. The statutory auditors of the company, Deloitte, has resigned. The company has stopped making or stopped servicing its the debt obligations. With in a few cases, the government has started investigating what is happening in Byju's because of all these things. Now, a valuation report given 6 months before, would you as a valuer would take your pen, sign off on the valuation report, latest fundraise, whatever they did, the same value would you be able to give? A lot of venture capitalists who are going on to say that they have cut the valuation by 60% haircut they have given for all the investment values that they are holding in that company by use. Would you believe it? 60%. They've just said, I think it went on to 20 billion valuation or so, more than 20 billion. I don't know. It went beyond that. There are certain organizations which are saying my valuation of this company is only 5 billion now. And there are a lot of people who say that 5 billion is also not worth it, because there are a lot of information that has come out. These guys have went on for multi-year, whatever revenue that should have come, they have accumulated it together and booked it in 2022 only. Therefore, for 2020, even 2022, the auditors have not signed it. They have not even commenced the auditor. They mentioned in their resignation that they have not even commenced the audit and they have resigned. Data has not been given to us. Therefore, your valuation reports validity becomes very important. If I say this, the valuation can be used for however long it can be used. You are of the clear. You are given value as on one given date only, valuation date only, but they will use it for some other purpose. And if there is a problem, unnecessarily you will be called up. At that point in time, it's a waste of time and effort to go and stand in front of the regulators. So restrict it for 3 months. If it need be, let them come and ask us, can you extend it or give a new valuation report? We will give a valuation report based on the circumstances on that date. Disclosure, the section of the report is key in ensuring transparency. As such, valuers should clearly disclose any facts that are relevant and may lead to a conflict or perceived conflict of interest while performing in the analysis. 3 to 5 years, if you are related, some transaction that you have done, if you want to disclose it. These are again pretty straightforward items. Business interest, significant assumptions, nature and sources. Nature and sources probably is a new area. Where did you get the information? Whether it's an internal information given by the management, external information that you have taken independently from outside, or an external information given by the management. They have subscribed to somewhere, they have taken that information, they have provided it to you. Or is it an internal information like projections, etc., which they have directly given you, or an external information where you were able to separately subscribe and get. All that needs to come out. Principal procedures, all the procedures that you have adopted in doing the valuation needs to come out. Restrictions on use of report. Who should use the report, who should not use the report. Conclusions, be clear on report must clear statement of value ascribed, including the valuation date, premise of the value, the valuation methods relied upon, and the appropriate weightage based on placed on each approach. All this thing needs to come in the conclusion, if not in any other place. Factors, what are all the key material factors that were involved? Size or number of corporate assets or shares, their materiality or significance, any impact on controlling interest, diminution or augmentation therein, and marketability or lack thereof, prevailing market conditions and government policy in specified industry should be described in the report. Now, electric vehicle, how many of you know that there is a subsidy that is given by the government for purchase of electric vehicle? There is a subsidy that is given by the government for purchase of electric vehicle. So far, they have been giving it, and they are going to stop it. They are going to stop that subsidy. They gave it in the first phase. I think now we are in the second phase. Probably a reduced subsidy can come in the third phase. If that happens, what will happen to the volume growth? What will happen to the rate? Should I reduce my value? Because subsidy was there available to these people, they were able to buy it at 1,50,000 worth electric vehicle. They are able to buy it at 1,20,000, 1,30,000. Now, because subsidy is not there, will my value reduce, or should if I maintain at 1.5 itself, will my volume reduce? That whether have I talked about it? All those are key material factors. I'm just giving you an example that needs to come out in the report in the factors area. Caveats, limitations, and disclaimers. I don't think I'll have to jump very deep into it. You all know caveat is a warning or it is a caution. Limitation is restrictions. Where are my hands tied? I have not done a due diligence of this valuation of the data that is provided to me because that's not my job. That's a limitation. Disclaimer, specify or delimit scope of rights and obligations. If the information provided by the management is wrong, you cannot take me into task. If this is being used by a third person, I give a disclaimer that please don't use it. If this is used for the purpose of investing, please don't use it. These are all disclaimers. So warnings are caveats, my restrictions or limitations, and my me dissolving any obligation that is cast on me, it is disclaimer. Caveats, disclaimers, limitations, and disclaimers. Now, what are all the procedures that are involved? I think somewhere around 11 and odd procedures are prescribed in the valuation guidance itself, valuation report related guidance itself. IBBA is saying minimum do these procedures. What are all the procedures? Review of past financials. Not restricted to SFA valuers alone. Land and building, plant and machinery valuers also are expected to go and review the past financials. Somebody is saying this person, the asset land that we have been holding for 5 years, 10 years. This particular land, this is the document, do the valuation. They say in the document it says that 10 years it has been with the company. It has been bought by the company. For past at least 2-3 years, when you get the financial statement, 3 to 5 years, you are getting the financial statement. Whether it is there in the financial statements, look at it. For the purpose of SFA valuers or plant and machinery valuers, the same thing. They are saying giving a bill, look at whether that is there in the fixed asset register or not. In the financial statement, depreciation schedule, whether it is there or not. For SFA values, review the financials. Take a look at how they have been performing, whether they have been able to make a profit or not. All these things you should be able to take a look at it. Sir, I don't have, RP is not providing me previous financial statements, sir. I have followed up with him multiple times, he is not providing it. Go to MCA, you will pay 50 rupees. 150 rupees if you pay, you will be able to download all the information for the past 10 years. From the moment it has been systemized, online forms have been submitted, AOC 4 MGT7 forms or the previous forms were submitted. All information is available readily in the MCA portal. 50 rupees if you pay, you will be able to download it. So you don't have a line or a defense when the IBBA is asking whether did you review the financial statements. You cannot say that I did not know whether the financial, they did not give me the financial statement, so I did not look at it. You cannot say that. 50 rupees you pay, you'll be able to get all the information, be a balance sheet, and all. In my, at least in my calculations, whenever projections is given by the clientele, I take that projections, put it in my working paper. I also take the previous financials, I put it in an Excel sheet separately, compare whether it is reasonable projection or not. That's what I told you. The company which is making 1 crore rupees total revenue for the past 3 years, suddenly somebody is saying that it is going to make 2,500 crores in the next 2-3 years. It is unreasonable. There is a possibility that can happen, but it is a very remote possibility. But if there is a possibility, let them give an explanation. So far, we have been doing it as a mom and pop shop. Suddenly, now we are infusing technology into it. This is how we are going to scale from 1 crore to 2,500 crores. So much investment we have done it for the past so many years. Now we are going to leverage it. There is some explanation to it. Okay. Otherwise, it doesn't make sense. Review and analysis of the financial projections. Again, the same story. You should be able to look at the profitability, whether the same profitability is the you are able to make it in the previous financial years that you have seen, whether the depreciation is the same. Are they capitalizing? What happens in a lot of cases, all technology related expenses, all employee benefit expenses will be capitalized. Most of the cases in technology companies are very simple to achieve profitability. Very simply, anything and everything related to technology, they capitalize it. Oh, this is an intangible asset we are building. It's a platform that we are building. After 5 years of tenure, once the funding stops, they'll go on and write off. Oh, this entire platform is a waste. This entire product is a waste. We will not be able to use it. They will write it off. This is one of the big frauds that are happening. One type of fraud is the revenue accumulation fraud. The other one is the capitalization of revenue expenditure fraud. Now, after you do this, internal information, you are very strong. You know what the company does, what is the previous financials looking like, what are the projections that they are giving, what is the basis on which they are done the projection. You should be able to go on a unit economics level analysis. So if they are trying to sell something, what is 1 unit cost for it? What is the 1 unit marketing cost for it? What is the overhead loading, vertical overhead loading, horizontal overhead loading? What is the revenue they will be profitability that they will be able to keep, margin that they will be able to keep, and what is the total revenue that they will be able to achieve? All these things you should analyze. Next, once you do this, go to the industry analysis, go out into the market, get all the information that is available about the company, similar companies. First approach itself, you'll have to go and do the market approach, whether applicable or not. Go and try to find out similar companies there or not. Obviously, as I told you, very similar companies are very difficult to find. Ashok Leyland and Tata Motors are different. Tata Motors and Mahindra are different for their own individual reasons. Therefore, these kinds of differences, even if it is there, bring out, make sure that you record that you have done the industry analysis and these are the differences, and therefore you have come to these conclusions. It doesn't have to necessarily come in your valuation report itself. At least in your working paper, it needs to come out. Then SWOT analysis of the company, ask from the management, make sure that whether the analysis is good or not, you do your own individual analysis and keep. I don't want to go into the details of SWOT and all now. Something that you'll have to do. Comparison with similar transactions, if you have access to aggregator sites like Venture Intelligence or these kinds of websites, similar kind of transactions which are publicly available, they will give you a summarized version of it. If you have access to these kinds of websites, get those informations and you can put it in the working papers. Comparison with other similar entities, pretty much industry analysis itself, this is also covered. Discussions with the management. This is again very, very important. You will have to summarize all your analysis and go and discuss with the management to understand how did they arrive at the projection. And all these discussions with the management, this needs to come out in the working paper. Also, this discussion needs to be consolidated in something called as the management representation letter, duly signed by the management. They would have orally confirmed a lot of things. They would have written you mails also. Consolidate everything into a management representation letter. What is going to happen? They are saying that this is a value that we are going to arrive. This is how we have arrived at it. Put everything in a management representation letter. get it signed from them, so that tomorrow they will not say, oh, we did not know. You have done the calculation. Why are you asking us? No, the assumptions is based on your information that has come out in the management representation. Review of principal agreements and documents. Very, very important for land and building and plant and machinery folks. You'll have to go through the documents. What document you have reviewed, it has to come out in your working paper. What relation it has, how much importance have you given, where did you get the information? In a lot of cases, they ask whether the document have you gotten from the client. Once you get from the client, did you derive it, rely on it directly, or did you take it to the registrar's office to verify that it is the original document or not? This question is being asked every now and then now. So you'll have to make sure that whether this document that you're holding is the original document or not, you'll have to verify. Now, I'm not going to go deep into it. Let's move on. Procedures. Site visit. Did you go on to do a site visit? Whether it was a desktop valuation, mention it.
Sorry, I'm just interrupting you, but regarding this verification of, agreements, deeds and all, should not we rely upon the legal opinion or from the approved lawyer or something like that? And is it part of our job to, verify the property deeds from registrar and all?
If you are able to engage a legal professional for this separately, it's okay.
Okay.
If you don't engage a legal professional, the minimum requirement is to get it checked with the registrar.
Okay. Isn't it then becomes a forensic audit than the valuation?
I agree, but lot of forums, the question that come to us is, if something is given to us as original, how do we take it as original or not? If somebody is submitting the balance sheet and P&L, we are going to MCA to figure out whether it is actually submitted with MCA, and we are absolving ourselves saying that, oh, it has been submitted with MCA, it should be original. I am going to the registrar of companies. When I say MCA, it is registrar of companies, to verify, counter check whether what they have given is right or wrong. But when it comes to property documents, I'll have to go to the registrar only. Our normal registrar. At the minimum, we should go see the EC, sir. Whether there is any encumbrance of the certificate in the EC, whether this person's name is there or not.
I don't know, sir, how far it is practicable, but anyway, thank you.
No, but EC, my question is, EC, is it free, easily accessible throughout India or not? I don't know. I'm going out of my class of asset. I'm a SFA valuer.
No, it is not possible in case of for example, audit also. Now, once we have an audited report duly signed, does it our job to know about the capitalization? Just you mentioned a while ago, whether it is a capitalized or being a revenue treated, the auditor's report itself is a self-explanatory. Why, as a valuer, I am going to comment on that? I don't understand. Sorry.
I agree with your point. But though it is not your job to go and do a forensic analysis of previous financial statements, the reasonability of the projections needs to be established.
That is correct, sir. That is accepted. That is fine. Yeah,
that's where I'm talking about. The previous financial statements, we will put the entire onus on the auditor. He has complied with the accounting standards, auditing standard. He has done his job reasonably well, is what I would expect, as long as it's the original document.
Definitely. But again, on the same point, if the company has a policy over, for example, past 5 years also they are capitalizing, and the projection also they are capitalizing. So how far is our scope to look into the lines, between the lines?
No, if there is a policy that is there, and if you as a valuer, as an expert in the field, feel that this is okay to go with, then it is absolutely fine. You are saying that it is profitable. I mean, you're increasing the profitability. If it is not unduly increasing the profitability, it is fine. But if you find that there is a stark change just for the purpose of valuation, to increase the valuation, if they are doing it, it is not reasonable. Okay. We cannot take the cover that, sir, management has given. I have not applied my mind in the projection that is given. That's the point I'm trying to make.
Agreed, sir. Agreed. Thank you.
Yeah. So reasonableness needs to be there. So that is one point. Next, site visits and desktop valuation we have covered. Any assumptions made for internal condition or any other specific assumptions made must be explicitly stated. Assumptions I told you we talk about key assumptions, we talk about any unusual assumptions, all that needs to specifically come out. Process of site identification, self-identified or with the help of the client's representative or client itself. This again, as a valuation, as part of our procedure, we'll have to make sure that how did you, this will predominantly be for latent building valuers, how did you identify the asset? Did you go and you independently did the identification, or you took the client's representative or the client himself to do the identification of that particular place? Needs to come out. This will be more, it will be much better if a land and building valuer can, if some land and building valuer wants to throw light, I would ask them to take the opportunity to tell this, because I have seen in multiple, this is again not from my own experience, but rather from a lot of sessions that I've attended. Identifying a land is a very surveying of that land is a very technical job. There's somebody, at least in my experience as a chartered accountant, I go to a place, there is one construction company which is also into making these sports fields. They have acres of land. I go to that place, they have built a big cricket pitch, not a cricket pitch, the entire cricket ground, they have built it there. I stand at the center, the owner goes from that well till that compound, and all the way up to this tree, to that tree, this flat, it's entirely our space. A land and building valuer would be able to take a map, measure, and say that whether it is right or wrong. For me, I had no clue. I relied on the document. I made a simple calculation, and it came down round about the value. I said, okay, well and good. You have actually purchased this property. You have a document, and when you entered, nobody questioned. Your people are all around. I think I'll have to accept it and move forward. But as a valuer, you are an expert of the field. You should be able to do it with documents. Take photographs, document it when the documented for the purpose of your working papers, because when the regulator is going to ask, you should be able to produce. Moving forward, we will now jump into the area of case study. Another 15-20 more minutes, and then we'll go into the question and answer board. In the best interest of the registered valuers, I'm going to take out the names. I'm not going to discuss about their names, because importantly, nobody knew 2017, 2018, 2019, 2020. Nobody knew how valuation reports have to come out. Probably there are a lot of guidance that were there. We are not very aware of it. So therefore, a lot of mistakes were committed. That's fine. Now they have formed a lot of disciplinary committees, and cases are taken up. I'm just going to talk about the company which is involved in these cases, not the registered valuers. Mr. A, in the case of Kohinoor Paper News and Newsprint Private Limited, he has gone on to do a valuation. That case, it has, unfortunately, all these cases are plant and machinery cases. What is the problem? Assumption while calculating the valuation of inventory, finished goods in valuation report, the valuer has gone on to take certain assumptions. I'm going to circle the areas where the assumptions are taken. As I told you, this valuer has gone on to look at, he went on physically verified the particular inventories, and he found out that the assets are not in saleable condition. It's not in good condition. They are in the godown. Physically it is present, but it has depreciated so much. It has been sir, you can put yourself on mute. So far they have where was I? Yeah, so it has been kept in a godown. Obviously, fair value and liquidation value is being calculated. It's an IBC case. A lot of problems. Godown, whatever asset they have been carrying, that asset has depreciated in value. It has become almost scrap now. Our valuer, through his prudent internal judgment, he has come out with a realizable value of 20% of the market value. Market, if it is sold, it can be sold at 100 rupees. Now he is saying it can be sold as a scrap, only 20% is the realizable value. If it is a fair value, if you are under stress as a liquidation value, I will only probably give 5%. This is what our valuer has gone on to give for the purpose of finished goods. In the case of raw material, he has valued it at 15%, and for forced liquidation value, he has given us 2%. These are extracts from the report. Now, the disciplinary committee, the investigation authority, I think it's IA, investigation authority, they went on, they did the scrutiny of all these valuation reports. They plucked about 10 to 15% of the case, for 20% of the cases, and they've started looking through, and this is one of the cases. What they are saying is, how did you arrive at this 20% and 5%? You have not brought it out in the report. That's their question. The RV has not explicitly mentioned the basis of the above assessments in the valuation report. The RV has assumed the fair value without giving due consideration to relevant facts. Based on what factor? Though you have said that it is not in a saleable condition, though since it is a biodegradable item, all these explanations are beautifully given. But how did you liquidate to that value of 20% or 5%? How did you arrive at it? It has not come out. This is the case. Now our valuer has responded, but he has responded in a different fashion. The practice of writing inventories down below cost to NRV is consistent with the views of that assets and should not be carried in excess of the amounts expected to be raised from their sale or use. So obsolete inventory should be adjusted and price should be reduced accordingly. Due to lack of information, valuation inventory was valued on the basis of assumption. He has taken the context in a different fashion. He has responded this way. The authority, investigating authority, is asking for one simple question: how did you arrive at 20% or 5%? Since he has not given a response in that manner, the authority finds that the valuation report, neither the valuation report nor the calculation sheet gives the basis of assumptions made. They are very clear. They are asking, how did you make the assumption of 5%, 20%, 15%, 2%? How did you arrive at these values? Even in the calculation sheet provided, our valuer has not provided that information. Therefore, it has not been done. The valuation has not been done in a scientific manner and fails to set out all necessary information behind the valuation estimate provided by the valuer. Because this was a case which was this report was done way back in 2017 or 18 or something like that. No proper information was available to all the valuers as to how to do this valuation. Though he has explained the condition under which he has taken that value, how did he liquidate to that value? He has not mentioned that. So they have asked the valuer, they reprimanded the valuer. They've said you have to be cautious and transparent and have let him go. You can see in a lot of other cases where the offense is less serious than this, they have taken action. So I don't understand the rationale behind why they have taken action on one valuer, but while they have left the other valuer, I have not come to the understanding of it, because the written value, the final report of all these cases talks on an abstract topic. What actually happened during the meeting, we never know. Therefore, I don't get into that. But this is one case we'll have to be careful about. Any number that you're talking about, have a calculation behind it. You can take it from online, you can take it from the client, or you could have come up with the value yourself. How did you, any market comparison, how did you come up with that value? You'll have to be very clear. Mr. B, in the case of R&B Simmons Private Limited, this is the second case, on indication of valuation standards adopted. I think this is the case where the valuer has mentioned that he has followed international valuation standards, but inadvertently in the report he has said that I am following an internationally accepted valuation standard. Instead of specifically mentioning international valuation standard, he has said internationally accepted valuation standard. Therefore, that was taken up. Next issue regarding methodology adopted. The RV in paragraph 3.2.1 of his valuation report for the CD, that under the depreciated replacement cost method, the current cost of the assets is evaluated after giving regard to some parameters. However, while estimating the value of the asset, the RV had nowhere touched upon these parameters in this report. Now, whenever you are using any valuation approach, after the valuation approach is chosen, next you will have to come down to the approach and talk about the methodology you have used. And you should also talk about how that methodology is used to do the valuation. When I use income approach, I come down to explain how discounted cash flow approach, discounted cash flow method is being used. why discounted cash flow method is being used, why it is better than the dividend approach or the earnings approach, the dividend discount model or the earnings discount model. Why DCF model is better? I'll have to explain that. And I'll have to explain the entire concept of what is discounted cash flow. I arrive at the cash flows for the next 5 years using the methodology. I arrive at the risk-free rate. I arrive at the cost of equity. I arrive at the beta. I arrive at the cost of capital. Then am I using the free cash flow to the firm model, or am I using the free cash flow to the equity model? If it is free cash flow to the firm model, how do I calculate the weighted average cost of capital? Then using this, how am I going to discount? How do I calculate the terminal value? What is the formula that I use for calculating the terminal value? Am I giving impact to marketability discount? Am I giving impact to control discount or premium? All these things needs to be discussed separately, which our valuer has not done. Though he has mentioned depreciated replacement cost method, he has not explained anything directly. He have come to the conclusion. Probably calculations will be there in his calculation sheet, but it has to be part of your valuation report itself. That's the point. Now, a few other things that he has contravened this. He has not mentioned this is a plant and machinery valuation. He has not given purchase price, installed capacity, conditions of the plant and machinery. Somebody asked me, valuation report already, sir, this information is already available with the user, sir. If the resolution professional, whatever he is giving, why should I reproduce in the valuation report? This is the reason. They are saying it can be available with the user, but you don't assume it. We are not in the valuation report. We are not testing whether the user has this information or not, whether the valuer has the information and whether he has considered it or not. Therefore, all this information, purchase price, installed capacity, conditions of the plant and machinery needs to be summarized in the valuation report itself. If you are not able to summarize in the valuation report, put it as an annexure, summarize it. The valuation report of the RV is silent on most of these items, giving rise to the point that the estimation of value is more abrupt than procedure oriented. Now, not required for you to jump into each of these cases, but if you give it in the report itself, it is as good as you considered it. Valuation inventory in the report, the RV has been also given the estimated value of the items which are classified as inventories in the balance sheet for the valuation of plant and machinery. RP has appointed 3 valuers and the other 2 valuers have not included the inventory. The board is of the prima facie view that the RV is in violation of 3H and 3J. The RP has very specifically said do the valuation for inventory also. Our valuer has not done it. It's a problem. You have not done the job that you are supposed to do. RP can very well say that it is also the responsibility of the RP to look at it and say, oh, this asset is valued by this person, this asset is valued by this person, this asset is valued by this person. It is being left out now. It is the RP should be also be jointly responsible for this, but at least in this case, they have got hold only of the registered value. Because they are saying the RP has appointed for him to value, for the plant and machinery valuer to value the inventories. Now, what is the submission by the RV? RV has very clearly stated he has not defended anything. The valuation was conducted in the year 2019 and was performed during the early stages of valuation rules. At that time, there was lack of understanding about the report writing procedure, the necessary elements that should be included in the report. The RV has assured that all the points raised in the show cause notice has been understood by him and will be incorporated if not already addressed. He has very clearly raised his hands up and he has said, I don't know 2019. I am also new to the profession. The evaluation rules also is very new. We did not know what to do. 2020 only guidance and all came. Before that, I did not know what to do. Therefore, I don't want to defend any of this. I have corrected, rectified it. If you feel this is wrong, it is wrong. We would have thought that the IBBA would have taken a lenient stance. RV has neither countered the allegations made by the show cause notice nor provided any justification as to how his valuation report is in compliance and with the applicable provisions. Evaluation report is expected to be complete. Again, they are going to talk a lot of details on why evaluation report is important and how you have let down the regulator as well as the users of the evaluation report. In this particular case, Mr. B's registration was suspended for a period of 6 months. So we don't know what is the rationale that is going behind this. Certain cases, it comes out with a warning. In certain cases, it comes out with a sentence. So see, in the case of V3 Engineers Private Limited, again, this is a case where methodology that is being mentioned, it has not been explained. The figures estimated by the RV is more arbitrary in nature rather than being based on the factors indicated by him in part 3 of the valuation report. Whatever you are talking about, you will have to liquidate whatever information that you are giving, liquidate that, make sure that the points are connected, dots are connected, and then you arrive at the value. If the information provided are in the air and it has no connection with your value, it will bring us down to this particular problem. Information stated in the valuation report is applicable for both the calculations and the reproduction and the market method. All the calculations are made based on the required parameters, as without required parameters, it is not possible to compute at all. He said that we have used it. I have done the calculation. Valuation report I have not given. Working papers are there. Please use the working papers, computation sheet. The RV has now, the IBBA has found out that the RV has placed on record the computation sheet utilized by him in preparing the valuation. The valuer has the liberty to exercise his professional judgment while estimating the value. However, assumptions with respect to discounting factors must rest on some logical basis, which should be recorded in the valuation report itself for consideration of its stakeholders. You are at the liberty to take some assumptions, but how did you arrive at the assumptions? What assumptions you have made, please record in the valuation report. Don't keep it in your calculation sheet, depriving your users of that information. Again, in this case, just because he has all the calculation sheet ready and immediately after the information is called for, he was able to immediately run to the regulator, give all the calculation sheet information. He was let out with a word of caution. My suggestion, in case if you have done valuation in the past 3, 4, 5 years, 2017 onwards, whatever valuation reports that you have done, if you have not prepared a proper calculation sheet, high time, go back. Probably you would have it in bits and pieces. Make sure that you're putting it in one Excel in one folder and then making the story perfect, because today itself you would have forgotten 70-80% of the information. What little information that you have in your mind with relation to that, put it in one document, at least keep it ready, so that tomorrow if the regulator is going to call you up, you will at least be able to present that information. If not in the valuation report, at least if they are able to see it in your calculation sheet, they might leave you with a word of caution rather than a suspension. Again, this is a issue with regard to methodology. No convergence between methodology indicated and the final value. The report claims to have taken into account various factors, estimated the value of the machines. However, the summary sheet contains fair value and liquidation value of 2 sets of machines without any justification on how he has abruptly reached these figures. They have said we have used this methodology, but they have not given the calculation as to how they arrive at the fair value or the liquidation value. Only 2 sets of figures have been given. There has been hardly any effort by the RV to connect the methodology indicated with the final figures derived by the RV. You will have to be very careful. As I told you, RF, RM, beta, everything, whatever you're talking about, talk about not only about the methodology, but also talk about where did you take that figure. RF I have taken from RBI, this is the value. RM I have taken from here, beta I have taken it from here. Cost of capital is you calculate using this formula. This is how I calculate. So 7% plus 2 into for 1.5%. Totally I have arrived at some 13%, 14%, whatever is the value. This is how I calculated, established in the valuation report itself. Don't expect the regulator to come and ask you. Though fair value and liquidation value are determined systemically by following principles of valuation, and value arrived at or after due calculation, it escaped the attention of the RV to attach the calculation sheet to his initial report, which has now been provided by the RV in his reply to the show cause notice. Again, in this case, he has not given in as part of the valuation report, but in this case, again, this person has given the calculation sheet now as part of his response. The valuer has the liberty to exercise the professional judgment while estimating the value, but logical basis should also be recorded in the valuation report. Please provide that is what their findings is. We'll see what is the order. Again, the purposes of the case with a caution to the valuer. because he had the calculation sheet, and immediately after calling for the calculation sheet, he was able to give it. They leave off the valuer with a warning. Be cautious. Letter E, in the case of RB Simmons, use of specific valuation standards. It was observed that the RB in his report has stated that he has neither verified the record nor has conducted the complete physical verification of the asset. It appeared to the board that RB has copied items from the asset register with complete nomenclature and date of purchase, assigned some value to each item without going into the details and without considering the physical verification. This is alleged in show cause notice to be in violation of sub-rule 3H and sub-rule 3J of rule 8 of the valuation rules, where they talk about in case of liquidation value, make sure that at least physical verification is done. I have assumed for the purpose of this valuation that all the machinery mentioned in the asset lists are physically available at the site. Leads to only a small. Then, after the show cause notice is issued, the valuer in all his excitement, he has said that I am not physically verified, sir, so I will not take responsibility. I have done a desktop valuation. But unfortunately for him, it is a liquidation value. He did not read the law properly. Law says in the case of liquidation value, you cannot do a desktop valuation. You have to do a physical verification. Now, after realizing that, the valuer has said that it is only for a very small items, insignificant value, which are large in number, randomly scattered. I have not done the valuation. Other items I have done the valuation. Now, very rightly, IBBA was very clear. Statement specifically states that all machinery in its original report have been assumed to be physically available at the site, but the RV in his submission has qualified this statement also to the extent of only small items of insignificant value, large in numbers and randomly scattered. However, such qualifications are not seen in the valuation report itself. Therefore, it essentially means that he has not done physical verification for any of the asset. It is a contravention. I'm not going to get into the details of it. I'm going to just get into the final part because we have one more to go. Oh, this is a different case. Well, same case. Again, he has not given purchase price, installed capacity and conditions of the plant and machinery. He has not given things that the RV, things that the factors considered by the RV during the valuation and as stated by him in his reply in IA must also be part of the valuation report. Accordingly, the authority holds the contravention by RV as mentioned in the show cause in this regard. So they have held it to be in his contravention. They have given 6 months cancellation of registration. Okay, Mr. F again in R&D observed that RV was not specifically indicated the valuation standards followed by him. This is the case again I was trying to mention. RV submitted that he has done the valuation following international valuation standards, IBS, and the same has been disclosed in page number 3. He is saying that he has disclosed in page number 3 that he has followed international valuation standards. But in the page number 3, the investigation authority finds out that he has mentioned that he has explained different methodologies followed under the internationally accepted valuation standards, not international valuation standards. Therefore, again, this is found out to be an incorrect statement. Non-inclusion of justification for the estimates made in valuation report. Any estimates, assumptions that you're making, again, you'll have to give the estimations or how did you arrive at the estimations that you'll have to come out. If it is not there, it is a contravention. Again, in this case, also 6 months. Now, I'm going to skip a few items here. Probably I'll touch upon a few points here. Give me a couple of minutes more, 5 minutes more. Then probably I'll take up questions. As usual, appointment letter, board resolution, engagement letter, management representation letter, working papers. Everything should be there with you. After you finish all these 5 items, then please go on to sign off your valuation report. Appointment letter, before you start itself, you should get it. Appointment letter, engagement letter, and the board resolution needs to be done before you start the engagement. Management representation letter and working papers. Working papers is with you. It's the prerogative of the valuer to either disclose or not the value of working papers. But management representation letter, you'll have to give it to the management. All that they have said in the due course of the process, let them put it in writing, sign off, and give it to us. It needs to be there. I'm not going to explain this. Not going to explain this. Not going to explain this. Valuation report minimum contents we have already saw. Caveats we have already saw. Identify what needs to be protected. This again, these are all. Go back to October 2020. I think 2nd October 2020. valuation guidance on caveats, limitations, and disclaimers. There you can see these are all government, the IBBA itself, they are saying these valuation related disclosures, disclaimers can be given. I'm coming to this last point. Let me finish this before you go to question and answer. I'm going to explain only this item now. Business plan received from client. Are we giving disclaimer that the business plan received from the client without applying test of reasonability and due diligence? You cannot give this disclaimer. I'm just talking about items for which you cannot give disclaimer. You have received an estimate, you have received a projection. You cannot say that I have not applied my mind. I have not done basic reasonability check. And I'm saying that whatever is given by the management is what I have taken. That you cannot say. That cannot be a disclaimer. So essentially, what is the regulator expecting out of you? You should do a basic due diligence analysis. That's the minimum expectation. Physical verification. Are we giving a disclaimer that he has not physically verified the tangible assets in case where engagement is for providing liquidation value? The entire problem is the company is into trouble. We don't know what is happening in the company itself. They are not servicing debt. At that point in time, you go and say that I have not physically verified the asset based on document. This would be the value if at all it is present. Like that, you cannot say. So that physical verification not being done in the case of liquidation value ascertainment cannot be given as a disclaimer. Market related data. Are we giving disclaimer that market related data is employed in this report? That is example beta, comparable companies, comparable transactions, valuation matrices without testing appropriateness. If you are taking beta, whether you are taking unlevered beta, whether you are taking levered beta, whether you are taking levered beta adjusted for cash or not, if you are taking a transaction, whether the same level of transaction, you are taking a transaction which is in a couple of thousands and comparing it with a transaction which is in a couple of millions or couple of billions, whether this will be reasonable to compare that transaction with this transaction. Something that is happening in India, if you are trying to compare it with something that some transaction that has happened in the US, whether it is reasonable to compare this and that. So you should do a reasonability check. And even if you are taking data from the external source, though you mentioned the external source, you cannot absolve yourself of the responsibility to check the reasonability. Historical analysis. Are we giving disclaimer that he has not done any historical analysis while conducting valuation exercise, although the historical data have been arranged with reasonable effort? I told you, financial statements not available. You cannot say RP did not give, management is not providing the data. Like that, you cannot say 3 years financial statement, they are not giving. No, go to the website, you will be able to get it. Even in the case of the insolvency cases where the company, the RP is not able to give you the project report. See, what happens is the future, what they have planned would have been submitted to the bankers. The financial creditors will have more detailed information than the valuer, than the RP. They would have, the company would have submitted the project report. They would have submitted all the bills. Based on the bills only, they would have given the loan. Bills would be submitted. Everything will be available with the financial creditor. You should ask the RP to reach out to the financial creditors to get that information. One approach. Are we giving valuation conclusion based on only one approach without giving any reasoning as to why the other two approaches were not considered in this valuation? Very important. I've been talking about this for a very long time. You should make sure that you are considering all three approaches, eliminate two approaches with reason, select one approach with reason. Nothing wrong in selecting two approaches or all three approaches, but give reason why you are selecting one approach, two approach, or three approach, why you are eliminating the first approach or the second approach, one or two approaches. You cannot eliminate all three approaches. Now, another expert, are we giving disclaimer for work done by any other expert, and the findings of the same does not form part of the report of the RP? Cannot take an valuation opinion, any opinion from an expert, not bring in the valuation report itself and disclaiming of the liability also. Whatever he has given, which has been considered in the report, it can be disclaimed in his part. That also you'll have to check for reasonability. You cannot utilize the guidance provided by the expert and then disclaim also on that expert that this has been done. That cannot be done. So these are the 6 cases where valuation disclaimers are not allowed. I think I've gone a little fast, probably a little more theoretical, but wherever possible, we have touched upon cases. These 6 cases have been plant and machinery predominantly. Let us hope that IBBA takes a lenient stance on all the other cases. I have done a few valuations for IBC in the SFA asset class. I don't know whether I have compared 2018 when I did the valuation. Probably I've covered most of the guidances that are given by the IBBA and the International Valuation Standards. Probably 1 or 2 might have slipped. I have followed International Valuation Standards, that's very clearly mentioned. Those important aspects I've mentioned, but certain areas probably a little lag might be there. I don't know whether they will take it up or not. If you have also done some valuation, please at least prepare the calculation sheet ready, so that in case if they're asking, you'll be able to provide. Now I'll open up the floor for any questions. Sorry, we only have 5 minutes. If you have any questions, we'll go for the questions and then wind up.
Hello, good evening, sir.
Yeah, good evening. Tell me, sir.
Am I audible, sir?
Yeah, you're audible, sir. Please go ahead.
Sir, my name is Tali Tato. I'm from Arunachal Pradesh.
Okay.
Very good evening to you, sir.
Yeah, good evening.
Sir, actually, my question is regarding the validity of the report. So, sir, actually, usually I'm doing the banking valuation, in which we are not generally write the validity of the report. So if it is so, how can we write the, if I want to write the validity of report, how can I write? I mean to say it's for 3 months or 6 months. Usually banks are doing revaluation after 3 years. So
3 years. So
yes, generally, sir, banks they do revaluation after 3 years, sir. So in that case, sir, how can I write the validity of the report, sir?
I would suggest 3 years is the bank's guidance. What the banking guidance says is that for 3 years, they don't have to come and reach out to you for a valuation report, new valuation report. That's what the banking guidance is.
Yes, sir.
It doesn't mean our valuation report is valid for 3 years. So we can very specifically say that this valuation report is only for 3 months. 3 years, nothing. We don't know what will happen. 3 years before, we did not know. A lot of people would have gotten their paid a few crores to go study for a doctor in Ukraine. 3 years before, we did not know there's going to be a Russia-Ukraine conflict. A lot of consultants who were in this field, they have lost their business itself. They send people to Ukraine, medical courses, they have lost their business itself. So 3 years is a very long period. Probably you can extend up to 6 months, but I would suggest 3 months. In our report format, say 3 months, give it as a report. Whatever the bank is asking for in their own specific format, in one line, you can mention that all the information that has been requested by the bank in a specific format has been given in Annexure E, and give it as a format.
Okay, sir.
Give it as a complete list, you give it to them, let them pick out Annexure E alone and use it.
Okay, sir. Thank you, sir. Thank you.
Any other questions from anybody?
So with regard to physical verification of assets, I think the cases that you mentioned right now in class was relating to plant and machinery valuers, is it?
Yeah.
So as an SFA class or I'm valuing a business, so that when I'm doing under the DCF method, I'm checking out for projections and all. So my historical data, I have an audited statement of the amount, the written down value of PPE, plant, property and equipment. So with that, can I just verify, the basis of the additions that they provide, or should I actually go and physically verify the assets?
Okay. If we are going to do an NAV based approach or a cost approach, then we will definitely have to employ another asset class, and they are going to do the physical verification. We don't have to do the physical verification.
Okay.
But if we are going to look at the additions is with respect to the future.
Yes.
Physical verification is not possible.
Not possible.
Therefore, you don't have to do the physical verification. But
And
that
for the
being-
historical,
For historical, we don't have to worry about. We have audited financial statements.
Yes,
Auditor, they are certifying it. We'll have to absolutely believe what the auditor was prepared.
Sir, and also
That being said, one word of caution, at least go and visit their registered office premises.
Okay.
Because there have been cases where registered office itself will not be there. Company itself will not be there. We will be certifying financial statements as a chartered accountant. We will be certifying valuation reports as a registered valuer. And then one fine day when the authority goes and finds out that the company has never existed in that premises for the past 5 years, we will be under trouble. We have not done due diligence.
Okay.
Basic.
Sir,
Yeah, go ahead.
so in this merger, one company is going through, we're valuing according to the DCF method, and the other two NAV, because they're in the, so I have to clearly mention that for those two companies, it's a liquidation value.
Okay.
Is it in my report? Okay. And sir, over there, the PPE and all is a very immaterial amount. So should I appoint another, should there be another expert in this, like in thousands?
100%. As
There should be.
stepping out of our boundary if we go on and do a valuation for other asset class. So even if it is immaterial, it is the responsibility of the management. Actually, you don't have to appoint another person. If you can, you can. If you don't want to do it, ask the management to appoint another valuer to give you the value.
Okay. Okay.
We cannot step out of our boundaries. The asset classes are very specifically demarcated. We'll have to stay with that before we move forward.
All right. Okay.
Hello.
Yes, sir. Go ahead.
Hello, sir. Are you here? Hello.
Yeah.
Please
Please go ahead.
me.
Yeah, I'm able to hear you, sir.
Oh,
Please.
okay. I'm planned. Okay, sir. Planned.
No, now you're not audible, sir. Now you're not audible.
Sir, can you report?
Nope. You're not able to.
Preparing the
No, sir. I'm not able to hear you properly. Can you text it, sir? Can you put it on the chat box? Okay. In case of the provisional figures are provided for any previous period before audit, how to value inventories? Can you text, sir? Can you put it in the chat box? We are not able to hear you properly. At least I am not able to hear him properly. Anybody else able to hear him?
No, sir.
Okay.
How are he? I will send.
No, sir. Sorry, they're not able to hear you. Please put it in the chat box. I'll read and I'll respond, sir. I'll go back to the chat box questions. Quickly try to respond. Please put it in the chat box. I'll read and respond. If a company has 10 subsidiaries, if one subsidiary appoint for valuation, the next year, can we do the assignment for another subsidiary of the same company? Yes. See, valuation itself we are doing, sir. For the same company, I've done valuation 1 year before. This year again, I'm doing the same valuation of the same company. It's okay to accept it. Valuation will not preclude you from accepting another valuation from the same company. So don't worry about that. But disclose it in the financial, in the valuation report that I have previously done valuation of this company, which is related to another company. It's the same holding company or it's a subsidiary company of the holding company, which holds another subsidiary company where I have already done the valuation. Disclose, but you're not precluded. You're not excluded from doing the valuation. In case of provisional figures are provided for any previous period before audit, how to value inventories in this case? Provisional figures are provided for any previous period before audit. How to value inventories in this case? Sir, if inventory, the point is there is a huge debate, but with this case law, latest case law, one of the case laws that we saw, it's very clearly settled by IBBA, inventory goes with plant and machinery. So provisionally they give, however they give, probably we'll have to bring it out in the report, in the annexure. But the plant and machinery valuer has to independently ascertain the value, fair value or fair market value and put it in the report. So it doesn't has anything, our book value or NRV, whichever is lower and all, not the case. We'll have to go with plant and machinery value through his expertise. They have to come out. Mobile phones are available. Thousands of mobile phones are available with say Xiaomi in their plant, it is having it. If somebody has to do the inventory valuation, a plant and machinery expert has to go and check the viability, whether it's second-hand goods or first-hand goods, what is the date model. The mobile phone, I remember using a mobile phone with 512 MB RAM or something like that, 256 MB RAM. There was one Nokia Lumia with 256 MB RAM I was operating. Today, my mobile phone with 8 GB RAM is struggling. So that is the level of difference that has happened in the past couple of years, which I as an SFA valuer will not be able to ascertain, but a plant and machinery valuer will be able to ascertain. What is the effect of impairment loss in plant and machinery valuation? What is the effect of impairment loss? Sir, I think impairment loss, you're going into accounting standard. What is the effect of impairment loss in plant and machinery valuer? There is no impairment or loss. That date, what is the value that the asset can fetch? If you are saying by impairment, if there is a serious mechanical problem with the asset, it needs to be taken into consideration. They will look at the particular asset and find out whether it is in a running condition or not. If it is not in a running condition, if it needs to be repaired, how much is the cost that is going to be spent in repairing the machinery? If it is not repairable, what is the scrap cost, scrap value? That is what we are going to arrive. So impairment loss with regard to valuation report will never arise. It's an accounting standard matter. Last year has shown the loss. Oh, in your books you have last year you have shown it as loss. Whether should the valuer take it into consideration? No. Why does he has to take that into consideration? He has to do his own independent judgment. This year, what has happened? This year, as on the valuation date, what is the value that the valuer arrives will become the value. If they again, because of that, you will have to go for an impairment loss. Now go ahead and book an impairment loss. Last year, 500 rupees worth of asset was written down to 250 rupees because of impairment loss through a registered valuer. This year, again, registered valuer comes and takes a look at the asset, and they find out that it is worth only 100 rupees. Now 150 rupees you'll have to write down. That's the idea. Okay, so I think we have zoomed past our timelines. Thank you so much for staying with me. I'll end the session with a small quote. Try not to become a man of success, but rather a man of value. Being registered valuers, let's hope to try to imbibe that value with us. Somebody from Divya Jyoti Foundation, please take.
Yes, sir. Yes, sir. So we have come to the end of this CEP. Thank you very much, sir, for taking this session and covering the topic very nicely. You have covered all important issues and finer points very nicely, sir. Thank you very much. And thank you, participants, for participating. Please share your feedback and suggestions. Thank you, Kajal. Thank you very much.
Thank you, sir. Thank you, Santosh, sir.